Hello, viewers. This is Saurabh from Tax Accountant, and today my topic of the video is how you can reduce your tax bill. Now, this question is in my mind, your mind, all of my clients' mind, and wherever higher search on Google is on that as well. How to save on my tax bill. So these are just some practical tips I want to share with you today. That how can you lower your tax bill. So be with me for next few minutes. And I want to start off with an example. Let's say there is a company. Now this is New Zealand specific, but company rates are individual rates are could different into different parts of the world. But this is when company tax rate is high, company tax rate is not low. Some parts of the world, such as Hong Kong, top of my head is only 5%, Ireland 7-8%. So these kind of tax haven countries where they want to focus more onto investments and they want to call overseas companies to open headquarters there. So I'm not talking about shifting money from one country to another. According to me, that could be tax avoidance. But anyway, let's not get into that part because this is that's very hot topic. How Google, Facebook, and those sort of companies, we see in media all the time that there is a service fee attached to the major expense and how they shift the profits. But that's not the point. What's a legitimate way for small business owners? How can we do it and not getting into gray area? This is black and white, right? Clear. So let's say company tax rate is 28%. This is the tax rate. This is the company. Now annual profit of the company is $120,000. So the tax on that will be 28% of $120,000, $33,000. That's the tax bill. Now, what are the tax rates in New Zealand for individuals? As of today, these are tax rates that may change next year, I don't know, but this is the tax rates today. 10.5% tax on income up to $14,000, 17.5% between $14,000 to $48,000, 30% tax on any income between 48 to 70, 33% between 70,000 to 180,000 and 39% over 180,000. Now question, imagine if your income is 200,000, how much tax you will pay? So this will be on a structured way, marginal tax. So first out of 200,000, first 14,000 will be taxed at 10.5% and up to 48. So income between 14 to 48. So it will be structured like layer by layer. It will be structured. So the whole 200,000 is not 39%. It's simple, right? But it's still complex. I have seen a lot of clients, they think that I'm earning 200,000, I have to pay 39% tax on that. And it's not that they don't know. It's just that they just don't give any attention to it. They think 39%, I'm earning 250,000, I have to pay 39% tax. It doesn't work like that. You still pay lower tax rate. The income above 180 is taxed that way. Okay. So using that same example, if that 120,000 is company's income and the tax is 33,000, if the individual income, like personal income, person like me and you, if my income is $70,000, how much tax I will pay? So this will be worked out in this example. So first 14,000 will be 10.5%. Tax will be $1,470. Next 34,000 will be taxed at 17.5%. Tax will be 5,950. Next 22,000 taxed at 33% at 6,600. Okay, so almost all that 70,000 is gone. So total tax is 14,000. So if you want to know what is my tax on 70,000, so your tax on 70,000 is 20%. This is the effective tax rate. Combining all that different variations, the total tax have you paid is 20% of 70, around 14,000 you have paid. Let's look at the comparison. If there is a profit of $120,000, right? Company tax is 33, and the split what we did is 70,000 right? So your total tax work out to be 28,000. So now we have split the income. What I mean by splitting, that 120, we are saying the first 70 will be at 20% and balance 50, like 70 plus 50, and balance 50 will be so just to explain that again. So that 120, 50 and 70. Okay, so that 120 split into two parts, 70 and 50. So that 70 taxed at 20% and that 50 taxed at 28%, 14,000. Total tax work out to be 28,000. There is a saving of $5,600. Right? This is one way it can be done. Now, how this tax will apply? Now, this is a situation when you have a company and a working owner. But how this will work into sole trader or partnership? This is how tax system works in sole trader and partnership. So you draw a money for personal use, right? You draw, and then all these drawings that you have done during the year becomes your wages at the end of the year. And those wages will be taxed at the marginal tax rate in the previous slide I showed you. My tip here is you have to keep a separate business account so that it's easy for you or your accountant to do the bookkeeping and preparation of tax return. If you're a company, I already gave the example for a company, but if you want, you get two options. Use that example, what I just showed, where the shareholders and salary. So one option is you can do a salary. So you will be paid a regular salary from the business through a PAYE, KiwiSaver, ACC, and all sorts of stuff. And that's it. And the second option is you become a shareholder of the company. So all those shareholder drawings will be your income. At the end of the year, you will also be paid dividend on that income, and imputation credits and those sort of things will come. So it could be combination wages, salary through wages, or salary through shareholder salary, and dividend optional you can take on top of your salary as well. So that is one of the option for you. If you're a trust, how will you do if you're a trust? So remember one thing, trust taxation is done like this. So if trust has an income of $50,000, now trust tax rate these days is 39%. So all that income will be taxed at 39%. So you got an option. Option one, we get that income 50,000 taxed at a beneficiary rate. So beneficiary rate would be marginal rate. So let's say out of 40, 50 is taxed at 20% marginal tax rate, and balance 10 will be taxed at 39%. So by doing that split, you have saved 19% of $50,000, $9,500. That's the saving you have received. So key consideration that you need to give today is when you're doing your business and you're a new business, you got to look at your cash flow. So what is your cash flow? You have to put aside some funds for taxation and GST. You got to do some planning around what would be your salary and how the dividends will be paid to you. And you need to give some consideration to ACC and KiwiSavers and things like that as well. So this is how you can save some tax doing income split between the different people. Now this is a practical example which I just said before, that you can pay yourself a salary of $70,000 via PAYE and declare another 20,000 dividend on top of that. So this could be an example that can be done to maximize the taxation. The key point is the company, whatever company has paid tax on that income, to be retained in the business. So you can't do that. Company pay tax and take that money as well. So we got to keep that money in the business. This is called retained earning. Thank you for watching this video. For these kind of short videos like that, please subscribe to our channel and like this video. Thank you.